So in this section 1.3, we will learn about posting transactions, like using the rules of 5 head of accounts. How will we post the financial transactions in the books? So here is a quick recap of the previous section, how 5 head of accounts are recorded in the books. So we have assets, expense, liability, and revenue. And remember, like asset and expense are always recorded as a debit entry, and remaining capital, liability, and revenue are recorded as credit entry in the books. And how we can record these transactions, how we can use these rules, I will tell you in the next slide. So this is a practice question for us to practice today, and I will not leave you alone. We can do this question together, and I will tell you how to post these transactions manually one by one. So let's see transaction number 1. Started in business with 750 cash. So when a person is starting a business, so he is bringing $750 cash. $750 cash. So cash is current asset, as we know. Cash is current asset. So whenever current asset is increasing in the books, we record a debit entry, means our debit side will increase. Whenever current asset is increasing, our debit side will increase. So very first, before doing anything, we will record cash as a debit entry. So what should we write here in particulars? We will write cash. If you have cash in hand, you will write cash. If you have cash in bank, so you will write bank here. So let's say here we have cash in hand. So I will write cash. It is left align and $750 as a debit entry. Debit entry. So I told you, like every transaction has a dual effect. Every transaction has a dual effect. If one is increasing, then other is decreasing, or if one is increasing, the other is increasing. So what can be the reason? If cash is increasing in the business, so what is the reason we are recording cash in the business? So actually, cash is coming as capital in the business, and we know whenever capital is coming in the business, capital is increasing in the business, we will record a credit entry. We will record a credit entry. So here, capital $750 as a credit entry. So our capital is increasing, capital is a credit entry, and it will increase the $750. So that's it. It is very easy. So for example, let's say a person is coming with $750 cash in bank. So what will we do? We will write bank. It is an example, simple example. It is not part of this. Bank 750 and capital 750. So this is how we can differentiate between cash transaction and bank transaction. Okay, I hope you have understood. Now coming to the next transaction. So in transaction number 2, we can see bought goods for cash 110. Bought goods for cash 110. So we can see here cash is going out from the business. Cash is going out from the business, means cash is decreasing. And why cash is decreasing? Because we are buying goods. And remember, whenever goods are coming in the business for resale purpose, so we will write purchases. We will write purchases. Okay, purchases. And it is an expense for the business. So we are buying actually inventory for resale purpose, so we will write purchases. We can write inventory, we can write purchases, or either we can write merchandise. So there are different names in different systems. So here we will use purchases for term good. Cash is going out from the business. So we know that cash is a current asset for the business, and when cash is going out from the business, so it should be credit, because when cash is increasing, so it is debit. So what will be the vice versa, opposite? So cash is decreasing, so it will be the credit entry, 110. So why cash is going out from the business? So every transaction has a dual effect. So we will write purchases. Because of the purchases, cash is going out from the business, and it is a debit entry. So purchases is a debit entry. Purchases. I hope you have understood. So it is also possible we can buy goods on credit, and we will see this type of transaction in next class. So transaction number 3, bought goods on credit from F Hurd. So the same thing. Now we have bought goods on credit. Whenever they say on credit, so it means we haven't paid any cash amount. We are buying on account on credit from someone, and he is the person who are we buying from. He is our supplier. Effort is our supplier. Okay, effort is supplier. So we are buying from effort on credit. So here goods are coming in the business. So we will write purchases, because inventory is a current asset, and whenever current asset is increasing, it is always a debit entry, 320 on the debit side. But why purchases are increasing? Because we haven't paid cash here, because it is it has increased due to the liability, because we have bought on credit. So we will write effort as a liability,